In this lecture example, we are going to look at section 6 quat. Now, you'll see, if you look at these examples, I've gone and I've given you guys lots of different steps to do it. So I've really tried to make it as intuitive as possible. But as we discussed it in the lecture, it's actually quite simple. So I'm going to show you a little bit of a shortcut to it. Not really a shortcut, but I'll just compress some of it. So, A Limited received income from different sources during the year. We received foreign interest of 100,000 rands. They say the foreign interest is the net amount after 15% of withholding taxes were deducted. So remember guys, if you've got 100% and you deduct 15%, you are left with 85%. And they say 85% is equal to 100. So guys, what are we going to include in our gross income? 100,000. I'm going to gross it up times what I want, 100%. What do I have? 85%. Right, so 117,647. Foreign royalties of 50,000. They say the foreign royalties is the gross amount, and they had to pay 12,000 taxes. And then foreign sales, and they say there were no foreign taxes on the foreign sales. So what I want you to see first up now is that the foreign interest and the foreign royalties, those two are amounts which have tax in a foreign country. So far they are the only ones that can qualify for section 6 quat. Because remember again, it must be taxed in both countries. So if it wasn't taxed in a foreign country, doesn't get included. And then we have South African sales. So I ask you, calculate the tax payable by A Limited. Tax payable, not taxable income. So the first thing we do, guys, is we calculate our normal tax payable. So check foreign interest, foreign royalties, foreign sales, South African sales, get our taxable income, tax rate, that gives us our tax. Now we want to do section 6 quat. So what are we going to do? You are going to identify everything which was subject to tax in both countries. And what were they? The 117,647 and the foreign royalties. So foreign income subject to foreign tax plus SA tax. So I'm just breaking it down for you for now to remind you, because we taxed twice, is 117,647 plus our 50,000 rands. Okay, so 167,647. That's the first step. The next step is we say, how much SA tax paid on that? So how do we know? So we say 167,647 over my total taxable income times by the tax, 270,941. 167,647 divided by 967,647 times 270,941 gives me an amount of 46,941. Right? And guys, I just want you to see that's what we see over there. Alright, so that is now the South African tax on that. What is my foreign tax that I paid? How much foreign tax did I pay? They tell you 15% on the foreign interest. So 117,647 times 15% is 117,647 and 12,000 rands foreign taxes. Okay, so 117,647 plus 12,000 rands. 29647. What is the lowest of the two? 29647, and that is the amount that will be deducted from your taxable income. Right, so this is the tax, or sorry, taxable income, sorry, from your tax. That's my tax. There's the rebate. Can you see? Right. So now it's the same story. Next one. The foreign dividend, so we've got a couple of things here. First up, foreign dividends is the gross amount. Okay, fine. Foreign royalties is the gross amount. Fine. say foreign royalties were $909, spot rate at the end of the year, or when it was paid is 15.12, and the average exchange rate is 13.20. You need to know that you have to use that. And foreign taxes, there were nothing on it. Right, then A, what is the tax payable? And assume that you own 25% of the shares that declared the foreign dividend. Okay, so if you own 10% or more of the shares, it is 100% exempt, the foreign dividend. So, foreign dividend in, foreign dividend out. So I want you to just make sure that you see now, important here, it is a null effect. If it has a null effect there, it means thus there is no South African tax on that amount. Then we have our foreign royalties, foreign sales, South African sales, taxable income, and we calculate our tax. Now, remember, if I just take you back, what was our first requirement? We said, what is the foreign income subject to South African tax and foreign tax? Okay, so I'm going to just do it here next to it. Foreign income taxed in SA plus foreign country. Let's go through the list. The foreign dividend is 100% null in South Africa, so that's not included. The foreign royalties is taxed in South Africa because it's included in our calculation, and the question told us that it was taxed in a foreign country. So the only thing we have here is the 62,000 rands. Our next step is how much is a tax on that. So it's the 62,000 divided by our taxable income of 862 times our total tax. Gives us 17,360, and it's easy because it's a company to do your test. If you say 62,000 times 28%, it also gives you 17,360. Okay, so it's correct. Just to remind you what we're doing there. Right? So that's how much South African tax we paid. How much foreign tax that we pay? So now we only look at that amount which is subject to Section 6 quad. So not the foreign dividend, because that's not taxed in South Africa. So we only look at the foreign royalty. $909, and we have to use the average exchange rate of 13.20. Don't let them catch you out by giving you different exchange rates there, not knowing what to use, guys. Okay, 11,999. So what's my 6 quad rebate? It's the lower of 17,360 or 11,999. So it is the 11,999. Just to show you. There we go. Okay, then in B. B is the same situation. The only difference is, instead of saying we own 25% of the shares, we now only own 8% of the shares. Okay, so let's go and see. So this is our calculation. Foreign dividend in, because we don't own 10% or more, it is not 100% exempt. We use section 10b3, sorry guys, section 10b3, which says 100,000 times 8 over 28. Can you see? So our net here is 100,000 minus 28,571. 71429. Foreign royalties, right? Foreign sales, South African sales. Gives us our taxable income and our tax. Okay, so what's our first step again? How much foreign income taxed in South Africa plus the foreign country? And in this case, it is the 71429, because that ends up in our calculation, 71429, plus that 62,000 rands, which comes from the foreign royalties. So 71429 plus 62,000 is 133,429. 2. How much South African tax on this? So we take the 133,429 that we just calculated, divided by our taxable income of 933,429, multiplied by our tax, 261,360. Gives us 37360. Right? 3. How much foreign tax did we pay? Okay, so let's go back and see how much foreign tax did we pay. We paid 15% on the foreign dividend, and we had this $909. So 100,000 times 15% is 15,000, and then 909 times 1320. Okay, now in the lecture we spoke and we said we do not take section 10b3 into account. Now what I want you to understand what that meant, if you go back to your lecture, it does not mean that we don't take it into account in the calculation of our taxable income. Yeah, they're not saying don't do that. What they're trying to say is, so I want you to understand, we received 100,000 rands foreign dividends. Some of it was exempt, so we're only getting taxed on 71429. So let me explain. So 71429 divided by 100,000. Right. You can obviously see what that is as a percentage. Is 71.429%. So only 71.429% of my foreign dividend gets taxed. But what I want you to see is when we're looking at how much foreign tax was calculated, you say 100,000 times 15% is 15,000. You don't say that 15,000 now times 71.429%. That would be applying section 10b3 again to the foreign tax. And they say don't do that. So they say ignore the fact that only part of it was taxed. Instead of only considering part of the tax here, take everything into account. So I'm trying to say, guys, it's a lot easier than what you think there. So they just say, just take whatever the foreign tax was. Do nothing. When you do the foreign tax calculation, don't do apportionment. Just put down what the foreign tax was. Right, so that gives us 26,999. That's my foreign taxes paid. This is my South African taxes paid. You take the lowest of the two. There we go. And that's it for section 6 quad. So guys, you don't have to do it as lengthy as I did here. You can be quick about it. And as long as you just understand how it works. A very, very simple section, guys. And again, remember, only apply it if they ask you to calculate tax payable, not if they ask you to calculate taxable income.